Let me know if the sound is good. Should be fine. Awesome. We'll get started here in just a few minutes, folks. Yeah, I'm just curious where some of you folks are at. Why don't you tell me where you're hanging out at? Wow, Dubai, all over the place. Nice, Indiana. You know I'm an Indiana boy, right? Why, Kelvin, 1:30 a.m. Awesome. Bo, Arizona. Awesome. Used to live in Austin, Tucson. Welcome, everyone. All right, give me about a minute and a half. We'll get going on this platform and start talking about a lot of things that are going on for sure. Wow, Romania. Hey, Peter. It's always cool for me to see this international audience that we have. We've only got 74 users on right now. All right, give me less than 2 minutes. We'll be ready to go. I am back and ready to go, folks. So, looking forward to today's show. I really have to apologize for last week. I had so much stuff hitting the fan as last live stream that I couldn't even focus on the meeting. So, today's much more quieter, much more focused. Everything should be good to go here today. As I mentioned in my video last night, there's several things I want to talk about. And the biggest story out there right now and the biggest debate out there is for sure whether inflation is transitory or not. So the general theory is, everybody knows, you hear it from Powell every time he speaks, is that this is just a reopening and there's a lot of constraints and things going on. And that's going to ultimately just dissipate and everything's going to be just like it was before. And the realities are nothing's going to be like it was before. We kind of all know that. And I heard something really kind of weird, interesting. And Biden, in a speech the other day, was talking about the existential threat of climate change. And I saw an interesting take on this. And I just want to throw this in because this has a lot to do ultimately with this inflation, is that they had so much fun locking us all down that now I've heard that maybe we need to just like stop people from traveling as much and change all the patterns of everything so we won't have as much CO2 going in the air, and that's going to make the planet better. This comes from the people that couldn't I'll never get monetized on this video, so I don't even care. It's, you know, it's really not that much money. But it comes from the people that couldn't control the virus, but now if they tax you more and slow everything down, that they're going to change the climate. That's what they're telling you. And I don't know what this next situation will be, whether they will actually try to do a lockdown for the existential threat of climate change. I don't know. It's just the insanity just can't get even more. And I just wonder at what stage that people lose their minds on all this stuff. So it's going to get interesting, to say the least. But so let's talk about this transitory situation. And I'm going to show you, we're going to go through crude oil. I've been talking about this for probably the last 3 or 4 live streams, maybe even longer, actually going back to probably November of last year. We're talking about the energy trade and that energy is going to continue to go up. Now the market queen of Kathy Woods tells us that crude oil won't go over $76 because the use of oil is going down, even though 3% of all the cars on the planet are electric, right? So, she's selling a narrative, and we know that. She bought $1 billion worth of Bitcoin this morning. Maybe it works out for her. My point is that energy is going to continue to move higher. That part of inflation is going to continue to be there and accelerate, and everything still runs on fossil fuels. To make a transition to electric cars, you're not going to see a Caterpillar big excavator run by electric, not for a while. They got a lot of battery storage issues to figure out to get there. That there's so many things that is going to be necessary. I get the vision, I get all that, but it's not going to happen for decades. So what do we do beforehand? You've got the current administration attacking every oil patch there is. They hate fossil fuels. So what they've already done, I saw a stat that right now that gasoline is up 54% year over year. And I was just looking at some of the natural gas. That's up a lot. This stuff's not going to come back down because they're choking off the supply, and that's important to understand. So energy is one area that I think we're going to continue to see this. It's not going to be transitory, and it's in everything, in my opinion. And it's not even an opinion, it's just in everything. Plastics, you name it, everything is still run on fossil fuels. You could, and I get the advantages, I get the efficiencies and all that stuff. And, I'm going to go through a bit of a rant today. I've been thinking about this for the last couple days, and these live streams give me the opportunity to talk about a lot of these things. And this will give me a chance to unpack some of this stuff. But there's other areas that are likely to be continued to be under pressure or upward pressure, and housing's going to continue to be moving higher. There's just one of the things, I'll transition here from energy, and we'll end up back and forth a little bit here. But when we look at housing's been being underbuilt for probably 10 years since the crisis 08-09. We're looking at under the number of homes being built, and supply has been about 5 million units, roughly, just an estimate. So less than what we needed. There are fewer units being built than what is needed to keep the growth of the country. So we find ourselves here right now in this big squeeze on real estate. And anyone's looked at rents and everything has just been crazy. And the other thing happening with rents, you have hedge funds and big corporations just buying up single family homes, basically sucking up what inventory there is there, and they're bidding these things because they're looking at the rent income. And this is significant, I have a couple friends that own some small apartment buildings, and especially if they're doing Airbnb, they're getting upwards of $3,000 a month running these things as Airbnbs versus renting them out for $800 a month. So these people are figuring out, depending on the area that they live in, and there's high demand on these things, this is going to continue to keep all of the prices higher. And in spite of reasonably low interest rates, but I'm going to end up there as well, I think there ultimately is going to be some pressure there. So if we go back to what Jay Powell is telling us, he's telling us that everything's transitory, everything's going to go back to normal. It's probably going to be 22 or 23. Maybe they're right, but I keep arguing on the channel that really what I see happening here is not transitory, and we're going to have enough data somewhere in October or November to go, aha, this is it. There's going to be an aha moment that we're going to find out even more what sectors, what areas are not going to be in play as far as this inflationary scenario. And I can't emphasize this enough to understand that this is going to be the case. Now, does that mean the stock market is going to collapse? No, not necessarily at all. That doesn't mean that at all. The Fed's going to keep their foot on the pedal. They're going to continue to pump the markets. That's going to continue. That's not happening. As far as a taper goes right now, they're going to have to print the 10-year over 2% before they see that kind of stuff. So I'll get into that. So bear with me. And as you know, you folks that have been around this channel, I usually go on this half-hour, 40-minute rant to start the show off. Be much more efficient today. We'll get through all the indices and everything very methodically, like I usually do. And there's actually a lot there, even though the market the market's really flattening out. I know it's higher by 0.08 right now, but it's not really higher. It's really stalling here. And even though we were able to push up yesterday, the momentum is stalling, the breadth is stalling. There's a lot of things that I will talk about as we go through today. But back to the, like I told you, we're going to go back and forth. Back to the transitory inflation situation, there's the other issue that I believe will even get worse is the supply chain. And if this crazy person is right and they do some sort of lockdowns, restrictive travel, something like that to control climate change. Now that we're back in the Paris climate change deal, and you've got all the G7 and all the big houses, we'll call it, in line with each other. As I think Mercan or one of these guys said, it's nice to have the U.S. back in the club, and the U.S. is back in the club. And the only people aren't in the club and will never be in a club is China. So all of this stuff they're doing is going to ultimately benefit China some way, somehow. But the point of all this is that we're going to see inflation continue. I still think it's too early to make the call on, yes, it's long term, it's going to continue to expand. Still need a little bit more data. I would agree with Powell on that, but he's pushing this narrative because it's the narrative they need to push to continue to execute. And let's just go into the Fed for just a couple minutes here, because I think this is also important to understand. The Fed, for the most part, they've always done this. Now, I've been through, I think, five Federal Reserve chairmen. They all do the same thing, all five of them. So so the five that I went through, going back to Paul Volcker, Greenspan, Bernanke, Yellen, and now we've got Powell here. And when we look back on all of the activity of what these guys are doing, they always have done the same thing. They jawbone the market. They want to talk and tell you, they want to affect market sentiment to buy into their narrative the best they can without actually doing anything. That's always been the way it's worked. I used to have a log, like a booklet like this, and I would keep track of every Fed action, every open market operation they did every day. And I mentioned this briefly on a video, I think Sunday night, is what we're really seeing here. It was last week, I think. But what we're seeing here is that they want to micromanage this through affecting sentiment. If the markets will do for them what they want the markets to do, then everything works out. We can go back to 2020 when they told us we're going to buy every bond on the planet if we have to support the market. Well, they hardly bought anything. Most of the money that they allocated for that, I think about 30% of it got spent. All the market participants got ahead of them and bought the bonds before they had to buy them, so they didn't even have to spend the money that they said they were going to spend. So this is just classical Fed action. This is the way they've always operated, even going back to Paul Volcker, who was probably the ultimate hawk. When I've talked about this before, he was willing to raise interest rates in the middle of a recession to kill the inflation. And we were printing 13, 15% at the end of the Jimmy Carter days and coming into Ronald Reagan. And when that happened, they did flatten this thing big time. In fact, that was the high of yields at 16.5% roughly on the long bond, and the Fed funds was 20%. And so what we saw from there was basically a decline to zero, right? Over the next 40 years, my entire career, we saw little blips on the bond market, but if you look at the general trend, it's just down at a 45-degree angle from 16% to zero. And now they have to maintain this low rate. And it's amazing, people freak out if the mortgage rate goes from 3.2 to 3.5. I bought a house in California and the interest rate was 13.5 and didn't think twice of it, and it wasn't affecting the markets. So markets and people and everybody tend to adapt to the conditions as they go forward. So it was a much interesting time. Now we've got basically all of this MMT, QE, all the stuff that we have in there. So we've got this thing, the bubble, filled up. I'm not necessarily a bubble guy. I think there is a very ultimately there is a very big decline coming, but for the moment that's not happening. I've told you before on this channel that I believe that one of the best inflation hedges is probably going to be the S&P, and I saw somebody saying the S&P to 4,400. I'll show you some objectives that are still out there at 4,600. There's moves up to into the 5,000 handle on basis of the S&P that are still valid projections. Whether they get hit or not, I don't know. But I'm going to try to bring back in just a little bit, and let's talk about if the transitory inflation is not transitory, what does that mean when we start to talk about interest rates, and I'll ultimately go through the dollar. Yeah, Abbey Road, let me see what you said here. Yeah, well, Harry Dent's been predicting a crash since 1992. Michael Burry, yeah. Listen, if they continue to, I'm not predicting a crash. There's no money in predicting a crash. And when we get the conditions, so let's go back to 2020. Let's just talk about that for a minute. Because in 2020, and you can go through if you're a subscriber of ours, I don't know if we have a free account anymore on our Portfolio Expert, but there's a dashboard there. I wonder if I can, I'll see if I can bring that up, because what happened was in early 2020, in January of 2020, what we had happen was we had massive selling out of our intermediate database. And so the market was about to collapse literally weeks ahead, and we were already seeing the deterioration of a lot of internal trends. And I don't necessarily say it was predicting the COVID collapse, but it did get ahead of it. We were 40-60% in cash on our institutional accounts, and a lot of those models were in cash. The short term was almost 100% in cash by middle of February. And of course, and on, I believe it was March 26th, we started to get substantial amount of buying. So there's no reason to predict those things. One of the things that I talk a lot about, if you're being an analyst, I've been an analyst since 1986, and paid as one in 1990. I was the head financial analyst for a firm with about 5,000 reps. There's no benefit in predicting those things. All those guys are saying it so it happens they can use it for a marketing piece, for a hit piece, like, hey, I told you guys it was going to collapse. What you're going to see from me on this stuff is that when the right elements and the right lineup happens, I will tell you, in 1987, I wrote a letter on September 16th, a newsletter that I used to write to the firm. I actually said that the risk reward in owning stocks is zero. Basically, get out. I wasn't predicting a crash. A crash happened, but that was because of all of the setups and the elements were right. I don't believe we have the elements for a crash right now. I get that prices are high. I get all that stuff. And one of the things I'm going to do in a minute is I'm going to go through the S&P, and I'm going to go from daily, weekly, monthly, and I'm going to go to a quarterly chart. We'll talk about the long-term wave count. Are we extended? Sure. Does that mean just because prices are high doesn't mean they're going to crash? And there's, like I said, I've never seen the benefit in predicting those things. What you do, in my opinion, is you have some methodology, which I do through our models, through everything that we do on our platform. You have a methodology, follow the methodology. If the methodology is worth its salt, it will lead you into a protective strategy when the time is right. And right now we're not seeing that. I'm going to go through all these elements here in a minute. So I'm going to continue on my rant just for a couple more minutes. And I'm going to touch on some high level stuff, and then we'll go into the charts and we'll start to unpack this concept that I'm talking about here in much more detail. But ultimately, all of this inflation will affect interest rates because we have a negative real interest rate right now. Everybody should know that. If you don't, we do. And that needs to be a positive yield. And two things have to happen. Inflation has to come down, but yields still have to go up to make that happen. I don't think we're going to see inflation sub 2% for a while. And the Fed's even told you that they're going to tolerate, this is what they said, they're going to tolerate a higher rate for a while until we get the full recovery, we get full employment, whatever that means, right? We were at virtually full employment prior to the COVID situation, and we definitely are a long ways from there. And there's been such a dislocation of workers. Everybody's looking for a new job, and nobody wants their old job. And there's, in some cases, the old job, no one wants that job. Okay, so I've talked a lot about that. Another segue here is I've talked a lot about that. The employment situation is going to remain in a very tight situation just because of the mentality. I saw a great comment on my channel the other day that somebody made, is that as long as there's opportunity in the stock market and you can make money doing this, why would you work, right? And that's true. You know, one of the hardest jobs in the world, which I'm going to be addressing here in a very in a class that I'm putting together right now, is, you know, how hard it is to make a living trading. It's very difficult and it's very challenging, and there's a lot of things to be aware of to even enter into that world. But a lot of people have gotten in there by chance through the shutdown and stimulus checks and Robinhood and all this stuff. There's a lot of things out there that I think are driving that. So if people are going to continue to make money in the markets, which I hope they do, I'm a big advocate of that. And I believe that what will ultimately happen is this job situation, a lot of these jobs that people don't want to go back to may be automated. So this is probably my final rant that I'm at. I'm about 25 minutes into this, and I'll go through this next little scenario here. And the idea that, and this is not just Kathy Wood, but a whole bunch of people, the idea that innovation and efficiency is deflationary is true. The problem is that the equation that's being applied to that is not realistic. This is an opinion, okay? It is not realistic. It takes a long time. Just like when I started off talking about converting the world to electric cars, that is a multi-decade situation. Now we see a lot, all the car dealers coming out. If you haven't seen the new Mercedes electric car, you want to see what a piece of shit that Tesla is, just go look at that. When these real players get in, Tesla will be challenged like you have no idea, because they're a plastic piece of junk, right? You should know that, even if you own one. I know I just offended you. You love your Teslas. But when you see that Mercedes, I realize, you know, and it starts at 80,000. I mean, Tesla done when these guys figure this thing out. Okay, so electric cars will be substantial, and you know, I won't go after Tesla anymore, other than, you know, and Elon Musk said this himself, is that his goal is just to get electric cars to be in play, and he's done that. Will he be the only player? No. These other guys have got way more capabilities than they do at Tesla, and especially since it's just a toy, you know, from a standpoint of the interiors are terrible. You know, for the money you're paying an awful lot, and Tesla wouldn't even exist without the subsidies they get from the government, right? So they're counting on that as well. So anyway, yeah, there's a lot of things I would like to talk about, but I think I've got all my major points out as far as what I wanted to get out here. So let's go ahead. I'm going to bear with me 1 minute while I'm on our website. I want to try to see if I can get to something here to bring this up. Yeah, let me put you on full screen here, and let's start just talking a little bit about the database. This is on our dashboard, and we're working on a new dashboard right now that I'm pretty excited about. Hopefully, we'll get that out pretty soon. But it's showing you this is our intermediate model outlook, and really what we're looking at is equities, individual equities. 65% of the equities are long right now. ETFs are 65%, and mutual funds are 65%. And you can see, this is what I wanted to show you. This was 113. You see a lot of selling coming in as we came in to the whole COVID situation last year. We bottomed out, and then you can see early on in April, we started seeing buying on our models, and they continued to get traction. We softened out in August a little bit here. We went into this choppy zone, and then we ramped up. And typically what happens here on this, in a trend and looking at our database from a modeling standpoint, is once the peak of number of stocks owned will happen, and then as we go higher, you start to see a divergence. We're back at 66%, and on a overall database, we're around 72%, which is a composite of everything. But if we look at this particular, typically what will happen is we'll see a retracement down to around 62, maybe down to 42%, which is a key number that I talk about in the videos every day. Once we get down to that level, the market, it does not mean that the markets are going to decline then. Typically what will happen, and there's not a good example on this page. Let me just see here. I want to try to take you back maybe to 2018. This is the beauty of this, is you can take this dashboard, you can take the dashboard back. Let's see how far back. Now you only go to 19 right now. That's a shame. I thought you could go back further on this. But we can actually bring the dashboard up on this date. It'll take just a second to bring up. So this is what back on 1/7/19. So this was, I really was hoping to show you how our database moved in 18, in that fourth quarter of 18. But this shows you we were down at 32% of, and you can see some of the numbers here, that we were at 18% of this. So this just gives us a snapshot what the database was. So we were down to 32%, and we actually in the fourth quarter of 18 got down to about 18% on the intermediate database. The reason why I show you this is going to talking about the crash. When we come back to the current markets, right? We come back to this current market. This is not the place that we typically will get any type of crash. We do have the divergence happening here where the peak happened in February. Now this is a weekly update. So what we're seeing here is the update is back at 66%. So that is a good thing from the standpoint of that. But we're going to have to get above 72%. If we don't get above 72%, then we start to get some vulnerability on a longer term database. So, all right. let's start to get into the charts, and we're going to go through the typical sequence that I go through as far as the charts go. Yeah, we're going to start with the daily chart on the S&P. We're up 4 handles right now, 42.50. This is something I talked about last night. I've got a cursor on it. This is the cycle event that happened. Last time we got a cycle, it was a little top there. Today is pretty critical, like I mentioned in last night's video. If we were to close lower, that would be a negative telling us we're probably going to come back into these moving averages, which would be 42.30 with the extreme of 41.94 coming in back in here. You can see that the averages, the PPMs, everything that's on the screen here have moderated or are really flat here. So there's no mo in here. There's no momentum. There's no vig, whatever you want to call it. It's just not accelerating here. And we're literally, if we went back and if we were to be scrutinizing this thing, even though we managed to make a slightly new high, we've been 42.30. We've been sideways for a while here. And so there's really nothing to be gained by spending a lot of time on this. But we look at the weekly, it's interesting that the weekly is about to get an RTX sell signal. 42.33 was the extreme for this week. And so we're trading above that extreme. If we close above that, then we are likely to see some back tracing over the next couple of weeks, flat to down. I think it was maybe it was 2 nights ago I put out markets to stall, and all the trolls showed up to tell me that, oh, is that what you call stall? I actually do call this stalling. We're not really, we're still in this sideways range. We're trading at the top end of the range, but we're not seeing the acceleration. And as we look at the PPMs on this chart here, we're really not seeing the type of acceleration that you get in these robust trends. And like I said, doesn't necessarily mean that the market's going to roll over and collapse and trade down. I thought we were going to get down to the 21-week moving average. It was 40.50. On the futures, we traded 41.25 overnight before Monday's open. Market rebounded, and off we go. Back toward the all-time new high, which we were able to print. So what's happening here is we're just range bound, and now we're exceeding this range. And I've talked about this at a lot of length over the last couple weeks on the channel, is that what we're seeing here is this narrowing is somewhat dangerous. It does tell you that there is some potential downside. I think the ultimate downside on this market would be that 40.50 level. That would be an absolute buying opportunity. I was hoping that we would be able to get to that this week, and it was certainly not predicting any sort of collapse in the market or anything of that sort, just to move down to the 21. And there's an old rule that my old associates Bill and I put together back in I think it was 83 or 4, is the first bounce off the 21 is a new high. And so what I was looking for here is for the market to come down and hit the simple 21 and then bounce and make a new high from there. It would have been awesome. We traded down to 40.50. It would have been a nice move, and we would have suggested that we would see much higher prices in the pattern. And we still haven't had that. So I think there's more weeks of grinding here. Maybe the grinding means we're slightly making new highs and all of that. But if you're owning any type of options and stuff in here, especially coming in expiration, they're going to take all all the juice out of those things, or the, any of the premium that's in there is going to start to get sucked out. So you're not going to get paid on these type of rallies in that situation. So you can see all this set up. Let's go to the next level, and we're going to go to the monthly. And monthly, where we are right now, R1 42.57. Okay, let me go full screen, make sure you guys can see this big enough. If you look at the market grid over here, R1 42.57, actually 42.57.47, the high so far 42.57.16. So we're trading in an R1, and we're less than a week away. I think next Wednesday is the end of the week, or end of the month. And so, whether we can get above that, the next level is 43.17. I remember talking about this early as we came into June, that there was a possibility we could get to 43.15, but I thought we were going to see an R1 number. If we look at S1, 41.50, right? 41.64. So we've done an S1, R1 for the month. And one of the things I want to point out here is we look at the PPMs. PPM1 is starting to cut through its first derivative. PPM2 is rounding off, but still in very robust numbers, all of these numbers. And all that's happening on the PPMs here are they're suggesting, I'm going to pull this over just so, I don't know how many, if you've been on this channel for a while, I don't know how many times you've seen this illustration, but I'm going to do it just really quick, just on one of the indicators again. Is something I talk about is you get acceleration, these indicators come up, and then they go in sideways, and it's a trend mode. And what's happening, these are the angle of attack. If you're a pilot, you understand the angle of attack. It's very similar from an aviation rule, is that if it goes too steep, it will stall. If it gets to a clean angle of attack, then this is a sustainable move. And what I've drawn in here is the angle of attack is likely to continue, or these moving averages will continue in this slope. But we are starting to see with this PPM1, this is like looking at the meters on an airplane. PPM1 is starting to turn down, telling you that angle of attack is starting to fade. The reason why we put the first and second derivatives there was to trigger what the probabilities were that we would fall back to the actual slope, which would be back to the 10-month moving average. And we don't have that full signal yet, but we're starting to see some of that start to come into play. So two things are going on. We're going to finish the month of June, and this angle of attack is going to increase. I'll take these lines off so you can see this. Right now we're up about 70 handles per month, so that number will be, let's just call it 3,900 as we come into June. It will be 3,970 as we go into July. As we come in July, it'll be 3,900. When we come into August, it'll be 3,970, and then it will be the 40 handle as we come into September. So there is an absolute bottom in this market from this standpoint. So if you're calling for a crash, you're going to be really, really disappointed. Okay, this is not the configuration that a crash came into, and probably would be worthwhile, but I want to get through the current market environment because this is important. I could go through and do a class on what a setup would look like for a crash, and we have plenty of examples in the past to look at. And one of the things that I talk about constantly, the problem with looking back at previous situations in the market is just that. Somebody made a comment on the channel that, hey, in March we did this. Well, my comment was, we're not in March anymore. So every one of these scenarios, when you when you try to compare something that happened in the past, you have to realize that things are similar but different. And every setup is different. The economic patterns are different. Everything is different when you're looking at this stuff. So you can't just say, well, that happened here, so it's going to happen again. When I see that, this is just exactly what amateur talk is, including like even guys like Ray Dalio talking about 1929 and what happened there. Well, it's not 1929. I may have told you folks this story. I had opportunity in 1987, 2 months after the crash, to speak at an international conference for Chamber of Commerce in Mexico City. And I had to make a 15-minute speech, and my job was to talk about the crash of 87, what was going on. And I started off my speech as I checked the calendar, and it is not 1929. Indeed, it is 1987. And let me tell you why the markets aren't going to continue to crash and why the economy is not over and all of that. And of course, it was absolutely the right thing to say because there were different setups. It wasn't 1929. Anybody that tries to compare 1929 to today, looking at charts, it's just not going to work out. The circumstances are different. We did not have the ideology around the financial world. There is a lot of efficiency through fintech, the ability, everything used to be done on a wire, like a hard-coded wire transfer. Now you can electronic transfer instantly, virtually everywhere on the planet. So when you can move money around and change money flows that quick, it's just a different game. And if you don't realize that, then you don't realize it. But my point is that the setups can be similar, but you still have to look at the backdrop. Another quote, one of my old buddies used to say, every time I think I know where I am, they change the background behind me. I'm not exactly where I thought I was. And that's exactly what happens here. And when you're looking at markets, you can't go back to March. You can't go back to 2020. You can't go back. Another quote, it's like trying to drive by looking in the rear view mirror, right? It works really good as long as the road stays straight. You might hit something because you won't see what's going on, but if a corner comes, you're definitely going off the road. So when you're looking back at previous events, you're just not a lot of validity in that, and you have to stay current and look at what's going on. And that's what I do with between the database that we have and the ability to do some technicals and use the WaveTech methodology. And I'll just yeah, it's funny. Gregory Kripke, Bob sounding like the professor of markets. Yeah, this is what I'm working on as a master class to really put a lot of these concepts and theories out there. And that is one of my nicknames is the professor, and it's an honor because one of my mentors who's left us a while back, but his nickname, that's what we called him, as a professor. So anybody to call me the professor, I'm quite thrilled to have that title. It was an honor because Frank taught me a lot of stuff. And so, but as we go through all this stuff, folks, it's not going to be anything like the last time. The top isn't going to look like it did in January of 2020 or in the fall of 18 or whatever. Okay, 2009 that's just history. And you can learn from history, and there are some elements that are going to be there and going to be relevant, but you're going to have to pay a little closer attention. I'm just telling you from my viewpoint, from my work, looking at the current market conditions, I always compared the PPMs as a best way to put it is like a measure, like how many clouds are in the sky. It can't rain if there's no clouds, right? I'm in Arizona. There's very, very seldom do we get clouds. And right now, this is our monsoon time, so we're actually looking like we're going to get rain today at some level, but we don't get rain like you folks do back east and other places on the planet. We get these little alien ships, these little thunderheads that float around the valley and around the state and drop rain in one particular spot. It's not, very seldom is it a widespread rainstorm, sometimes in the winter, but the summer the heat flows are so crazy. So this is the same setup here, as we need to look and see where the thunderheads are, where this thing is going to set up. What are the conditions right for a crash right now? And the answer is no. So I'm going to go through one more step. I use the S&P. It's been my focus for a very long time. So we're going to go over, and I'm going to bring up this chart here. I'm going to go full screen so we can go through this. So, yeah, I've got 38,000 words written in a book already. I just can't seem to get life to allow me to finish it. Yeah, and David Ford, that is one of the issues, is liquidity, how much liquidity was in the market in the last crash. That is always the issue when liquidity dries up. That will be the key. So, yeah, so you can actually estimate the probability. Somebody's saying you can't predict the future with charts. You actually can't predict, but what you can come up with is some probabilities of events occurring, and then you walk them forward. And that's what I do. That's what our software does. That's what everything does. And, you know, we've had the opportunity over the years to actually help to manage $275 billion since 1999. And, you know, we still are involved with helping a lot of advisory firms manage their money and do those things. And now we're working with you folks as an individual basis. But I'm gonna finish this S&P rant for on a long-term basis. And there's an argument here, and I've got TradingView up here now, and I try to keep. Yeah, it's always, yeah, Christoph, absolutely. It's always about probabilities. There is no certainty. You're right. Can you predict the market? Maybe not. But I can tell you in 2003, I predicted the top four, 2007 within 15, not even 15 handles. I think it was, it was 7 handles 3 years in advance based on some of the Fibonacci patterns and things that are out there. Didn't know it was going to happen, followed it, ended up getting right there. And in the high of 2007 was actually the high of November. We were able to figure this out pretty good. We walked into, our software company, all of our advisors that were with us, we only did institutional, walked into 2008 with 60% cash on January 1st. The market was down 8% the first week of January of 2008, and that was the beginning, as you know. And in March and April, we started buying with both hands. And so, you know, the point is that there are probabilities, there are things that you can do to try to mitigate risk and participate in the market. So we talk about participate, protect, and grow. So we got PPG, right? You participate when the markets are trending. When they're going down, you protect your assets, and then you stair step your assets over time, or you grow your assets over time. You know, sometimes you beat the S&P, sometimes you don't. That's not necessarily the game. It is really about being able to protect your capital and get it to stair step and grow. And there's a lot of people in our group that have figured out this concept, and it's very, very valid from that standpoint. So let's talk about this long-term wave count. And what we're looking at here, this goes back, let me just, every time I get on TradingView, I'm not real proficient. But this particular pattern that I'm showing you right now goes back to the lows of 1932 lows. So this way over on the far left of the screen is the crash, and then the lows of 32, and then everything that would walk forward coming into really the crux of World War II was a big bull market. Of course, we had the Great New Deal. We had a lot of pumping of the markets and confidence being built in through the beginnings of the socialist network in the U.S. to be able to get this thing to start to move much higher. And it did just that right into the 70s. And I mentioned my mentor, the previous Professor Frank, who was not really a professor, but that's what we called him. During this time, between 1974 and 1980, every $10,000 of clients that he had turned into $1 million. So he turned 10,000 into $1 million, and he was very famous in our little network, and he did some amazing things going forward. And it was it was an interesting time to be around the markets. 1980, 79 is when I started, and that was the beginning of really a big bull market. Right, this little bar, if you can see where my cursor is right now, that was a 1987 crash. It's a one candlestick, you know. It was very quick, and this is when I was right here in the next bar was when I was in Mexico City telling everybody that the markets weren't going to collapse, the economy was not over, and we weren't going to see any material change in economic activity. And of course, you can see we moved on. And one of my famous quotes back in 1995, and no one's going to believe what's going to happen to this market. It was going to blow up. And I didn't necessarily see the .com situation, but what I did see was all the probabilities lining up for the markets to go higher. So as we come into this level 3, this is a super cycle 3 back in 99, we'll call it 2000. But as we go through what ended up, and I remember talking about this, I used to write commentary and do an annual report on our website, and just for our institutional clients. And I talked about this pattern being an ABC4, and that we were going to have one more leg up in the markets. And here we are. This was the low right here in 2009, and now we're coming in here. This most likely, this bugle formation that everybody was talking about, was a similar, I'll call it a similar bugle to there was all kinds of Wall Street Journal articles back in around 1990, 96, right in this little sideways pattern here. Now what we're seeing, we saw this little bugle pattern, which I always see as very bullish. We've broken out of that, and we are, I think, still this big leg here. I've got 5 here, but I think there's a sub 3 in here, and we still have more to go. And there's a minimum move, probably a 46 to 5,200 on the S&P. It may extend. This particular sequence, it looks to be very powerful. As we look at this chart that we're looking at is a 3-month, each bar is 3 months or 1 quarter. So we're about to finish this quarter into an all-time new high. If you look at the PPMs down at the bottom, these things are absolutely screaming. We're up 5.57. It's one of the highest levels we've been. And this is also not the pattern that we're going to get before collapse. If we go over and look back in that rear view mirror, we see the way the PPM start to cut through its first, second derivatives, all this stuff happened similar as we came into the top. In fact, this stuff started to happen probably 6 quarters before the top was actually formed. We're not seeing that. In fact, we're seeing the opposite. We're seeing an acceleration. So I'll take the other side of that collapse bet. I don't see it happening right now. And like I said, coming up, I need to spend some time with this and come up with some estimates on where I think this is going. But I wanted to do a deep dive. I want to do a deep dive on some of this stuff just to give you some perspective. And I see somebody said, "Wouldn't the Great Reset is an A wave?" I think it was the bottom of a C wave. If we go back here, I hope you guys, let me see if I can zoom in on this chart. That would be handy. That's a really good comment, by the way. Yeah, so this first low here on October 18 was the bottom of the A. Then we went up to the high in 19 coming into January of 2020. And then this leg down here was probably the C wave. And now that was a wave 4. And now we're in a wave 5. I think it's a wave 5 of 3. I think there's a bigger 4 that sets up. And then ultimately maybe one leg up higher. We'll see. But with these PPM set like this thing is pretty huge. And like I said, I could probably spend, what time is it? I could probably spend another half hour just talking about this configuration. But the point of this is that what we're seeing is this acceleration. This is not, I'll emphasize, this is not what a top looks like. Yeah, David Ford, you're right. Every Elliott wave said gold 1930, pull back, then 1700, 2400 are very quiet now. Yeah, we'll go through some of this stuff because gold definitely had an abrupt change. I still think there's some decent patterns in there. I still have some longer term things that I think are good. But the big crash, good luck. I can't pronounce your name, Passler. Good luck on that. Yeah, and the Fed pump work. Listen, they're not done, folks. I'm going to come back full camera for a second, since we're so deep into this conversation. We're not done. They're not done with what they're doing right now. You have Janet Yellen in as Treasury. She's one of the biggest activists that there's ever been in the Fed. She wanted to buy individual equities back when she was Fed chairman. She lobbied for that. She wants to buy everything. Listen, the model is Japan, okay? Everybody wants to be Japan because everybody was predicting that the Japan would just collapse. And now if we were to bring up the the Nikkei Dow, there would be probably a very interesting thing to look at as far as where they're going. They actually proved that their model worked, and they went nuclear probably 6, 7, 8 years ago, and they just kept doing what they did. So that's the model, and the powers to be, the Fed, all the central banks, they're going to follow that model. They don't see it broken. So they're going to pump this thing up. That's why my argument about inflation not being transitory, I think they want the inflation. You have to look at, it's interesting because if you look at look at Germany 1921, what did they have? They had the hyperinflation, right? The Weimar days. and they just pumped things crazy, and they thought they could bail out everything. They could buy every company and do everything. They thought that would work. Well, it didn't. What did they get? They got Hitler right out of that. Now what we're seeing is the U.S. always is more afraid of deflation than they are because of the 1929 situation. So all of these central banks, not all of them, but let's say the major central banks all have some baggage from who their identity is and what they worry about. And this stuff is generational, and it's embedded into the mindset. And that's why the Fed wants that 2% inflation. They want that continuing. You start looking at this, it becomes very, very obvious what the plan is and how they're likely to be able to continue to manipulate things the way they want them to go. And so it is kind of counterintuitive to try to predict the crash. They're not probably going to let that happen, and they're willing to spend this. I mentioned in a video a couple of days ago when I played the Ben Bernanke lying or telling everybody what they wanted to hear, that they were going to shrink the balance sheet back under $1 trillion, just like it was before the 08-09 crisis, right? No, they never did. They got it down to about 2.2. It actually shrunk from 2016 into 18, and then it started to expand a little bit again, and we know the rest of what's happened. You know, I wish I had some really good charts. I had those on there on a couple of videos ago. I wish I had time. This is all I could do. And at some stage, I'm going to try to solicit some outside researchers. I see you guys as my army to help me out on some things. So there's some things that I'm working on in the background that I really want to do. And, you know, there's just so much to be garnered from here. And in the end, you know, I tell you folks all the time is, I know I'm selling, I have a product I'm selling, but my product that I produce was always for one reason. It was to help people get beyond the skills they had, including myself, by the way, and above the emotions of the trading. And that's when I was alluding, if you've been watching for a while, talking about how hard it is to be an individual trader and go through those emotions. And I am somewhat of a mad scientist type. If you put a piece of paper, I used to tell all my assistants, they would put some paper on my desk. I said, do you ever want to see that again? And she or some associate would go, yeah. I go, well, then don't leave it here, because second I touch it, it will get buried and disappear. So I have some really interesting things that I have an old seminar I did back in the 90s. It was called Becoming a High Percentage Trader. I had it in my hands in the last 6 months. I don't know where I put it. I know I didn't throw it away. It's here somewhere. And I'm going to break out some of those concepts for you folks at some stage. Yeah, and emotions do suck, and they always are evident. And this is something I'll just say to you is this is what I preach all the time: process over attitude and opinion. Emotions are attitudes and opinions, and when you start to get too opinionated, you get stuck in trades. They will take all your money. Whoever they is in the markets, right? The market gods will take all your money. So let's get back to the charts. And so let's move on and let's go back to TradeStation and let's start looking at, let's go, we did a deep dive on the S&P, so let's go to the next level. Now this is, maybe we'll do a top down this time. This is to me, this is very interesting from the standpoint of the NASDAQ. I've talked a lot about, so I'm going to do NASDAQ Russell spreads, NASDAQ versus Russell, and then we'll move on to interest rates and some other stuff. Yeah, and I agree. I wish I could. Someone said they will have to pump because the Biden administration infrastructure plan will never get off the ground. These guys in D.C. are chomping on the bit to have a summer vacation. Yeah, I agree absolutely. Um, that's one of the things that I think will happen here, is I believe the whole agenda is starting to unravel with the Biden administration, and I think that it's going to be more difficult to get these things done. And I think we're going to see challenges from this phase forward. So the honeymoon is over, and now as they start to push out maybe some more aggressive type strategies out there, I think they're going to get more and more pushback. And I agree, the Fed's going to be the only one to save them. And remember, Janet Yellen and Jay Powell are really good friends. And, you know, I bet you didn't know that it was the Federal Reserve's job for climate change, or the Treasury was climate change. But now they've got strategies that they're doing, and they're doing these things based on that ideology. And they're just going to do it. And I agree. That's why, as far as predicting any type of crash is kind of silly. So let's look at the NASDAQ here. And the NASDAQ, reason why NASDAQ has taken hold is a lot of these large cap stocks that come back in play. And we're really starting to see a lot of momentum be lost here, although it's still very robust. So we look at, this is a monthly graph that I've got up here right now. We look at the market grid here on the monthly. 14,315 is very close to an R3 monthly, so we're 14,440. The low was 13,451, and we got almost down to S1. So we're working on an S1 R3 right now. We've only got, like I said, basically a week to go. Next Wednesday, I think, is the end of the month. And so what we're seeing here is this thing finishing out, but we're seeing momentum on PPM1 flattening out, but PPM2 is still expanding. And all that tells us is that we're likely to stay above this 10-month moving average, which is that same line. I just want to go through some of the same scenarios. Talking about the angle of attack again, right? The angle of attack is at 1.75. It's flattening off. And so it's sort of like if you have thrust on an airplane, you have to maintain that angle of attack, you have to have enough thrust, and ultimately you don't have the same energy behind the thrust, so the plane starts to flatten out the angle of attack, but it will ultimately equalize those two things. Okay, same thing here. The thrust is going to be the amount of buying and volume that's coming into the markets, and then we're starting to see it slow down a little bit, but it's still robust enough. We're not in a crash phase where we get parabolic, where it goes too fast, where like any plane you finally get to that and it just falls straight down. That's not where we're at. And typically what happens in all of these patterns is you get this kind of a soft roll. You'll start to see momentum, what we're seeing here on the short term, and then what will happen is ultimately it will roll over. But we're looking at, what is this? June, July, August, maybe October, November might be the point where maybe everything's normalized and we've gotten to that point. There's no way to, my expectation is that that's what will happen. So we're going from top down, meaning monthly, weekly, daily. So as we look at the weekly, we're also on a weekly basis, we're right at the higher end of the projected range for the weekly. So high 14,315. We're looking at RXT weekly NASDAQ futures are 14,370. So we're just about there for this week. And what's interesting about this is we're seeing ppm 2 turn up, and ppm 3 is also turned up. So there's still underlying trends in here. Anybody that wants to troll me for trying to say because I said the market to stall is somehow the market to collapse, that's not what I'm saying here. These trends are very live, very relevant, and they're not going away anywhere. And when I talk about our short-term database, that's all that's happening there is a recycling, and I'm going to explain that once I get through NASDAQ, Russell, and the spread. Then we're going to go and talk a little bit about the database. Okay, so now we'll go to daily. And we'll probably just do weekly Russell, we'll do the spreads, and so we can move on. Okay, so daily, as far as today goes, 14,315, basically an R1. S1, 14,211. I mentioned this last night. I thought we'd get S1, R1. I don't see us getting as high as R2 today, and I think we've pretty much printed what we're going to print. Maybe in the next hour we'll get some more buying. I don't think that's what's in the cards right now. I think the markets are continuing this slope, just like I talked about a minute ago, this same angle of attack. We're at a plus 0.34, which is trend mode on the NASDAQ. 10-period moving average has only right now a 30% probability for the market to decline below it, 14,091. Not going below that. If you saw that number, you could buy with both hands, okay? This particular situation we have coming right now is actually demonstrating that this trend is continuing. It's not ending at this moment. I don't see that. Like I said, going back to the S&P comments, all I was looking for on extreme was the possibility of printing down to 4,100, maybe 4,050. That didn't happen. I covered that earlier. So if you just joined, make sure you go back and watch the replay of this. But the NASDAQ is going to continue. I believe that's going to be the case. Let's go ahead. Let's see. Let me go to weekly here, and let's go to Russell and talk about the Russell. And I'll use the Russell cash. It is interesting on a weekly basis right now. The 2314 is the high right now, and RXT 2313.75. So we've hit RXT for the week on the Russell, but we are seeing the Russell start to turn back up again. We've went through a period going all the way back to March of this year where the Russell has, for all practical purposes, been a flat line. It's fluctuated in there, but it's been a flat line. You could get the median price of all of these bars right down the middle, and it will pretty much be right where this 10-period moving average is right now, 22.68, and we're trading right now 22.38. That's kind of your midline to a large degree, and we're still fluctuating around there. We're starting to see the trend start to pick up, and what's likely to happen is the NASDAQ's going to try to play catch up, but the relative technical position, the NASDAQ versus the Russell, the NASDAQ still wins. It's got, it's a difference between having a large block engine and a small block. The large block's going to be able to get maybe better top end speeds, or it's got everything working for it. So let's go to the spreads. And this is a spread that I spent a lot of time talking about. And this spread, you can see, it's interesting how things have played out, because I've talked a lot about this. I thought we would see some resistance around this level on this shoulder right here, and that's the case. And this has been also the support line. So it's possible that this spread's going to stay in between these ranges that I've drawn in here. If it does this, then that won't be negative for the markets. It's just going to tell you the Nasdaq's going to continue to lead. In fact, the way things are starting to line up as we look at year-to-date returns is that it's possible that the Nasdaq ends up on top again, outpacing the Russell, even though it looked like that wasn't even a chance, right? There was a time when the Russell was up 18% over here, and the Nasdaq was up 2%. So it looked like there's no way that could happen. Now you've seen just an inversion of pretty much all of that, and you can see it here in this spread. And if we did like a swing measurement, if we took and I got a lot of lines here, let me redraw this. If we did just like a swing measurement on this, then we're probably looking at the spread continuing to deteriorate. And there's two things you can do with this. You can take the length of this and multiply it by 0.618, get a Fibonacci number, and take that 0.618 and average and put it onto there. That'll tell you maybe a target down here. If it's full equal swing where this is like an ABC where A and C are going to be equal, then that is going to move the spread down more. And it does not mean that because of that, that the markets are going to decline because the spread is changing like this. Just means that the leadership is changing. And I talked to going all the way back in September, October last year. I told you I expected to see the Russell, so value, small cap growth, all that stuff to come into play. Well, that is not where we are right now, and I believe some of this it's going to be interesting because it's going to have a lot to do with what I'm going to go into next, which is talking about interest rates and the dollar and those type of things. And so we're definitely seeing these patterns set up from intermediate viewpoint to start to tell a story of what we could expect potentially for the rest of the year. And we're really at halftime, right? We're in June. We're about to go into maybe the sixth inning right now if it's a baseball game, right? So we're about to go into the second half of this year and really start to see what the probabilities are and what things are, how they're going to set up. It's funny, Jason, he said, Paul says all the right things and then does all the wrong things. So, okay. I'm just looking at some of the chat here. Just a little bit, see what you folks are talking about. Yeah, so Brian's talking about the grid continues to narrow, and that is somewhat of a concern on when we're looking at some of these markets. But the recent volatility has helped a lot. Okay, so let's move on. Let's go to interest rates, and we'll tie together some of these things that I think are important as far as the transitory versus inflation. I think that's still a conversation that we need to continue to unpack a little bit further. And what is happening here. This is like one of the most bullish setups I've seen for a while. And this being a bullish setup is not necessarily a good thing, but it does look to me that we're setting up the final bottoming pattern of this, and we're going to head up toward this 200-week moving average, which is at the 190 level. Let me expand this box over here just a little bit so you can see this. 194. I talked a little bit about this the other night. Is what the pattern that's setting up here is really potentially the next leg before, I guess the pattern before we do the next leg up on interest rates. And I still expect somewhere between 189 and 194. That would move us up toward this. And the big number that was out there for a while was 175, which was that spike high back in March. And, you know, whether it's a tapering, whatever happens, or there's just more of an inflation story. And I do remember talking about this on a video recently, is that we have inflationary metrics coming out tomorrow to start. The deflator on the GDP comes out. I don't expect any big changes on GDP estimate. It's the third estimate, but I'm watching the deflator and then the PCE numbers on Friday. We could be right back into this talk today. We're seeing a little bit of a sell-off in the bonds. We're seeing 1.487. I talked about this also, is I think we're looking at 154 is the cap on the 10-year right now on a short-term basis. Ultimately, we're going to see 162, 164, and then lead us further up the trail. So let me go to a monthly graph and just bring this into some more perspective here. So this monthly is really telling the bigger story. And I do remember going way back here when we were at 0.65, and I was talking to you folks on daily videos when I cover these things. Typically on my Wednesday live stream, I just go through these big rants on a lot of markets and talk about a lot of things I don't get a chance to talk about in detail in a 12 or 15-minute video. And you know, a 12-minute YouTube video and editing and everything is about a 3-hour job. So these live streams are much easier. There's no editing, right? So, but the point of looking at this monthly chart is suggesting that this is where I get the numbers. 182 is the 40-month moving average, and right now 40-month moving average still has a downward slope. Remember, that's the opposite of when we're talking about that angle of attack. This is a downward angle of attack of 1.88, and we still have ppm2 at a minus 0.77. Meanwhile, we have this is really typical in a major bottoming pattern. This is what this setup looks like, and I'm working on a couple of things. I'll just tease you guys. I'm working on getting an offering out on TradingView, and that's coming. There's going to be a class that talks about these setups and all that kind of stuff that will be associated with that. And so I'm working on a lot of stuff. I just need to have some of the noise out of my life, and a couple elements did get cleared up this last week. So we're still moving forward. But the monthly moving average here is right now at 1.23, and it is going up at about 80 bips per month, right? So we're looking at 13.1 and then 1.4. in 2 months' time, we're going to be right at the levels where we're trading now. So that upward slope is going to come into play. We have a ppm of 6.90, which is an insane number. And what's happening is we got the crossover of the 10 and 21. Whenever I see what, I don't know, you can call it any of these golden crosses and all that stuff, typically what happens when you get the short term to cross over the long, it actually indicates a stalling of price, not an acceleration or a buy signal. It tends to take whatever the chart, it takes 2 to 3 bars to actually normalize and then for the pattern to actually turn up. So there's always some negativity around some of these crosses before they happen, and the inverse if it's a downward cross. But on this right here, that 10 period moving average will come into play probably around 1.4. I mentioned a couple of days ago I thought the extreme on the 10-year be 1.38 to 1.42, and the way things are trading, we'll see. This is a monthly bar, so this will be over. Looks like we're going to have some negative, I guess, as far as some of the upward momentum is bleeding off, but it's still at 6.9. It was at 13, so it was incredibly stupid up slope. That's why we get that stall. So when the slope gets too high, just going through theory again, when the slope gets too high, then the market's going to flatten off and everything's going to roll over. But then that upward slope is defined by that moving average. So each one of these ppms track a moving average, and they're simple moving averages, and they're designed to be used on simple. Exponential and weighted averages don't make them better. They're just a different metric. Okay, these metrics, and I've used since 1985, and actually 84 we've been using this along with ppms. And so all of this actually, this is an old theory for me, but the process is the same. Once that angle of attack comes into play, we have the probabilities are so high. Anything over 0.25 suggests that there's a 60% probability to hold the value of that moving average. And so this is what my work is about, is we attach, everybody uses moving averages, that's fine, don't care what they are, exponential. We use simple. All we wanted to know was, is there any way to determine if that moving average, what the probability is for the market to stay above it in an uptrend or below it in a downtrend. All we were trying to figure out, is there a number out there? Is there a way to put a measurement on a moving average? And that's where these ppms came from. ppm stands for price pressure momentum. And right now the price pressure momentum is huge. There's less than a 10% probability to decline below that value, which is not really in play right now because of the position of the market. But this pattern tells us that we're going to go sideways. We're actually setting up, if you're familiar, hang around the channel, I talk about a dragon head. This is a dragon head. Dragon heads usually resume themselves in the previous trend mode. So this would suggest that we would get a move to take out that 175 high at some phase. I think just based on this being a monthly chart, we're looking at a quarter, maybe 2 quarters to get in position. Maybe it doesn't take that long, but certainly we're looking at September, October. Goes to what I talked about in my opening rant, was I think that we're going to have some numbers and metrics out there that is going to point to that there is more non-transitory inflation than transitory. I'm not saying they're all not transitory, but all the major ones that matter, I think we'll have metrics in play then to actually be able to do that, to make those assumptions and have a reasonably high probability and confidence level that that's going to be the case. I still think there's some things to do there. So, okay, interest rates, done, right? Talked a little bit more about inflation, and let's go and I guess the next natural place to go to is the dollar. And I'm going to back up here a little bit. And we're going to go bottom up on the dollar. And there were some really critical numbers that happened several weeks ago. I talked about 89.23. Well, we held that number. We went sideways. We start to stair step up. Now we have a daily dragon head setting up. We did print substantial. We got to that angle of attack, got too steep. We're flattening that off right now, but it's starting to maintain at 0.18, which is a little bit below trend. But the key numbers that we're going to watch here, we did get above the 200-day moving average, which I thought we would at least get to it. And we did get above it. Now the 200-day is going to be in play, and we're likely to maintain above that. The very bottom indicator you see on this page is actually the WaveTech 200, which is the PPM for the 200 period moving average. And it's still expanding. It's above all of its first and second derivatives. And what that tells us is that there is about a 60% probability we're going to stay above that number. That number is 91.49. So that'll be the number to watch. We may dip under it a little bit, and we'll also have the 10-day moving average coming in play very quickly here. It's rising about 10, 12 cents per day. So 91.40 is going to be the number. That's pretty much the low of the session today. So we're going to be in play here where the 10-period moving average is going to be in play on a daily basis. So we go to the weekly chart, and what we'll see there is we got an RXT sell signal last week, but it coincides with the angle of attack getting too steep, pulling back, going into a consolidation. So based on this, we should remain above 91.50, 91.20. The extreme would be 90.75 on a weekly basis. And we look at the market grid for this week, low 91.51. We in between S2, S3, the R2 92.62. We fell short of an R1. So we got to just about an R1, and now we're seeing some backfilling. And we're also looking at the PPMs on a weekly basis are very neutral right now, and we're going to be trading around these moving averages. And that is likely to continue for at least another week. Okay, I'm just reading your comment, Super Donkey. Yeah, I know we have a lot of data fees and things to provide that product out. So I guess if lots of people would sign up, it would give us the ability maybe to do some things. But it's a very expensive product to run on the backside of this thing. There's a lot of data costs because we redistribute data and they charge you. Yeah, I do see, Brian, I do see the bank stocks coming back into play. I think that will be the play, and this may actually cause some of the Russell stocks. There's a lot of mid-cap and small stocks that are in that financial sector that end up being in play, I think, at some stage. Okay, so yes, thank you for the super chat, Super Don. Appreciate it. But let's go to a monthly on the Dow, and I think there's potentially a much bigger story being told here, and I think this kind of confirms the higher interest rates that I was just talking about. There's a number of things that are come into play as far as this stuff goes. We're looking at the bottoming pattern is setting up on a monthly basis. PPM1 has actually cut through its first and second derivative. All of the PPMs are turning up on a monthly basis. I don't expect any big bull market, but I do expect to see us move up toward somewhere around 94, maybe 95 handle on the Dow. And this index that we're looking at is heavily weighted on the euro. So I guess we could probably bring up the euro. We could spend a lot of time just going through this stuff, hours and hours and hours, for sure. So, but yeah, so this, like I said, plays into the interest rate scenario that I'm talking about, in that we're likely to see this thing continue to be start to move up toward these upper end of these moving averages, 94.49, 95.17. They're both declining still, so there's a lot of resistance up at that level, but it looks like the market is attempting to get to those levels. Next Wednesday, when we go through the Dow, we'll start to, I guess it'll be too late, that's the last day of the month. So the following week, we'll start to see that this, I believe this market grid will start to slope upward and start to confirm that these things are going to go. All right, let's go to, I guess a natural place to rotate here is gold. And I think I just want to back up, and we'll go through the daily gold. And some of the things that we saw in the last, when this collapse started here. Hang on. Be helpful if I get gold up there. Okay, the collapse that we saw last week in gold was pretty significant. We did get an STX buy signal. An STX buy signal is when the market closes below the extreme that is projected for a day, week, or month. And typically what that signals, it doesn't necessarily signal a big buy, but it signals a sideways to pattern to set up. And you can see we're into the fourth day of sideways. We printed up almost to 1800 today. We tried it. Talked about this in last night's video, that I think the market's going to want to seek back to that 1800 level. We get quite a bit of selling to come in off of that print up there. And we're back into this 1776 support level. I'm going to show you where that is. Been talking about it on the nightly video, so we'll get into that here in a minute. But one of the things that's happening, the PPMs are all major negative. PPM1 is a minus 0.64, PPM2 minus 3.1. So both 1 and 2 are in downtrend modes, and that has everything to do with the 10-period moving average, 1824. It's dropping $10 per day. So literally in $2, it's going to be right at 1800. You're going to have a substantial amount of resistance there, and there's going to be more work for this market to bottom. And the key number, which is the low that we made, was 1761. That's going to be your key level, and there's a support line in here. So let's go to the weekly, and you'll start to see how this pattern starts setting up. We got an STX buy on weekly. That suggests that we're likely to get some more sideways movement here, and at least another week. And like I said, here's that 1777.5, 1776. I'll show you that number here in a minute. But PPM are basically mixed to negative on the weekly basis as well. So there's substantial amount of resistance at between 1825, 1832. We're not getting through that anytime soon. And pretty much what we're expecting here is that we can at least hold S1 on a weekly, which is 1751. The low's been 64. The low that we saw last week was 61. That's where that number is coming from. And so, but we are seeing some of the ppms starting to stabilize a little bit, even though they're negative. Let's go to the monthly. And this is where the 1776 number comes in. The 21-month moving average is 1776.3. And the ppm on that is up at a 0.61. So this suggests that we should stay above that. ppm 1 is down at 1.17. So there should be a sandwich job between 1826, 1776. We're also potentially, if we stay below, what's the number here? If we stay below 1801 as we come into the end of the month next week, that will give us an STX buy signal monthly, which tells us we're going to come back into this 1800 handle and spend some time there. Now, I cover gold every night, and so I'll make sure that this actually comes into perspective. Yeah, so let's see here. Yeah, it's kind of scary. I see some comment about, World War III. China just has the largest navy in the world. That's an interesting thing. And while the U.S. worries about climate change, they're building a big navy. So it's interesting. But anyway, that's the gold synopsis as far as that goes. Probably the next thing I will go through here, and we'll talk about this in detail, is we'll do the cryptos here. What time are we getting to be? Yeah, so a lot of long conversations here today, so I appreciate everybody's patience and watching the channel. So we'll get into talking about cryptos next. And people are always asking me to do cryptos on a regular basis. I got to tell you, just even saying what I did now, these algorithms pick this up, and the bots that hit the channel is just crazy. There's 3 of us deleting bots off of the channel in the comments. And anytime you do cryptos, man, they are all over the place. Yeah, I saw some really interesting things on somebody's mentioning that Australia is getting nervous. Yeah, I think there's some interesting things going on there. Yeah, I'm just looking at some comments real quick before we go on. Yeah, China is economic war for sure. Yeah, I still don't think you're going to see 16,000 on the Bitcoin. Too much money involved now. It's just like any market. So let's go ahead and unpack those. Hey, Kathy Wood's telling you it's going to what, 500,000? She just bought $1 billion. We'll see how that plays out, right? So let's go ahead and let me bring up some things here. I can tell you one thing for sure on Bitcoin is that 60,000 number will be a high for a while. It was that was a crazy number in hindsight. So he basically got a 50% retracement. I really think what we're seeing here is a bottom setting up on Bitcoin in this level. PPMs are starting to suggest we're still very negative, so there's a lot of resistance. I remember last week I told you we'd see this range bound around 41,000. It was pretty much stuck within the ranges that I talked about last week. We'll get in the weekly mode here in just a minute. But we look at S1 33,065. We've traded almost down to S2 32.25, low 32,966. So Bitcoin trades a little strange, but I see S2 as an extreme, and this will be important actually from a daily viewpoint, that we need to close above, let's say, 34,000 by the end of today. So we need to rally the 600 points that it's given up pretty much today. If we don't get that rally, then we're going to be stuck in a sideways pattern for a few more days. We do have PPM 1 at a minus 0.97. PPM 2 is basically flat, so we're getting that potential crossover here. Let's see what the numbers are. Yeah, tomorrow the 10 period will cross through the 21. That's likely to put a stabilization in the pattern, and we're going to probably head back up to around 30, 39, maybe 41. Let's go to the weekly chart just to get that set up. And what I'll do Bitcoin and Ether will be the focus today. So this is the thing on a weekly basis. 35,309 is the 21 period moving average. It is up right now. I'm sorry, it is flat at 0.1, and PPM 3 is up at 1.62. So PPM 3 tracks the 40 period moving average. It says that there is about a 70% probability that will hover around this number. What we've been seeing, trade above it, trade below it. Last week I talked about the possibilities going to 41 and change. Went 41,315, went between R1 and R2 last week. The low was 30, what was the low? 33,351. And we're looking at STX was at 33,252. So we're staying within the grid. The grid actually downticked this week. The low of the grid was 27,303 extreme. We printed 28,824. So we went to STX. We bounced off of that, and it looks like we got a good chance maybe of getting, this is what, weekly, so we got a good chance of seeing R1 by the end of the week. 36,371, possibility of an R2, which would put us back above that 40 period moving average. I think that's what's setting up here, and it's going to take roughly probably 3 or 4 weeks, and it will be important that we hold and stay around this 40 period moving average. So when we do this review next week, we'll have some interesting things to look at. I don't think I have a good chart for longer term. I know this platform doesn't have a good monthly, doesn't have data back enough to do a good deal. So let's go and back up to daily, and let's go to Ether. Like I said, these numbers that we saw up here at these extremes, this is really extreme. I'm going to pop this over just real quick to a monthly, and you can see this bar. I was looking at Litecoin last night, looking at some of this stuff. This spike that we got on the monthly, just for the record here, that's a major high. That's going to be a high for a while. It's going to be, if we were talking Bitcoin, because I know the numbers, that's going to be 19,000 that we printed back in 18. It's going to take a while to get through this. And if you look at this range, it gets into almost like in Bollinger Bands, where you get that big bubble formation. This has happened here because of the volatility spike. This on a monthly basis has happened. I'm going to flash back I'll stay with this. I'll do Ether, but Bitcoin looks the same way. So let's go over and go to the weekly Ether, and similar situation that's in Bitcoin. The 40-week moving average is, this is ppm 3, is up at 2.73. So that's going to be most likely the bottom of this thing. 1478 would be an extreme. We look at the market grid for this week, STX 1636, low's been 1700, so we're almost STX on these things. It'll be interesting to see. This is a weekly graph, so Friday's close, we'll see how it works out. I'm not sure how these weekly graphs print. I think this thing might be set to a Monday to Friday type scenario, so I'm not sure what's good. I need to look at what the settings are on these charts to make sure these are legit. But the numbers seem to work out pretty good as we go week to week, so it's a good thing. Maybe you can take the weekend off. I saw one of the funniest memes I've ever seen in my life I think it was on Twitter, had something about me trading Bitcoin, and the guy's in bed with his phone in his hand, and his face is lit up from the screen, and he's watching Bitcoin trade, right? He can't sleep, so 24 hours, but that's maybe you can find a way to take a break. I find trading the Bitcoin and these currencies quite challenging emotionally. Okay. I'm just reading some comments here real quick. Okay. All right, I think we've got all that covered. Time is at 12:30, so we got about a half hour to go. Haven't looked at the markets because we are seeing them bid up just a little bit, back up 550 on the session. Let's take a quick look over here at this screen. And yeah, we're just kind of hovering sideways with a slight upward bias. Nothing really going on here as far as that goes. Just, yeah, 42.42 up 575. What's been the low? Low's been 30. So, and to me, this is stalling. So, not really seeing much here. So let's get back over and take a look at some stuff. I know Christoph, I saw your comment there. Yeah, it's pretty funny. Yeah, cryptos really mess up your head. Sometimes just coming in, trying to go to sleep at night. A lot of times I work late, and trying to stay asleep when like my body knows the market's open, so I can't sleep past the open. So I ended up getting short sleep. Yeah. Yeah, so let's take a look at a couple things here. And I was looking at something. I'm putting up our WaveTech platform. And let's just want to take a look. I'm going to set this for an optimized daily, and I saw AMC coming up. There's a couple things I want to show you, and this is trading the last this is a daily basis. We got a buy on AMC. Let me do, here we go. This would be a little better. Down at $12. We're continuing now. This is end of day. It doesn't reflect today's activity. We'll go to live charts here in a minute, but this is the pattern on the daily that's being held, and so that was a nice buy. There's a portfolio. I'm not sure if it's on this where I'm logged in at. I'll have to take a look here real quick and just see. I'm going to bring up WaveTech. I believe I built something. I called it, yeah, this is it. This is pretty insane chart here I'm going to put up. Let me bring this up here. I thought this chart would be somewhat crazy. Let me make it a little bigger so you can see it. I put in some months ago, back in all the meme stocks that were out there, and this was somewhat interesting. It did 250% in 1 month, and I thought, well, the rest of the year is just going to be giving it back. Well, now it's up. Let me just bring this into. It's now up 369%. So it just gets crazier and crazier as far as the markets go. But if we look at the open positions here, you're going to see AMC. This is on a daily basis. No, this is weekly models. Okay, so it's been long since December, but anyway, you can see the returns here. All these don't. I guess some of these I didn't get all the memes. I just left them alone. GameStop still got a position here. All of these stocks. So we'll take a look at some of these just to kind of unpack them. But the big winner's been AMC, and while that's a meme stock, it's also reflecting a lot of what's going on here. And what I can tell you is there's some. I built this portfolio I'm showing you right now. I built this. When did I build this? In January. These are all 31 stocks. Right now, own 17 of them. There's 30% in cash. The portfolio is up 190% this year. And these are stocks, if you look at the active symbols in this portfolio, you can see it's got Apple and Amazon and a bunch of these, but there's pretty basic stocks. They're not like super crazy stocks in here that I put in there. And so what we're seeing here is just there's a lot of opportunity if you can build these portfolios and really crank these up. I mean, we look at the monthly returns here. I mean, literally, we go through 21. It had a big month in January, and most of the returns were there. But even in March, April, May, we're still compounding this thing at a pretty high level from this standpoint. So, so let's go ahead and go back and let's take a look at some of these. Yeah, I believe you're right, Jason Bourne. We will see the banks do well and these rates start to move higher. All right, let's, what time is it? 38. Let's go through some individual stocks. So give me a couple stocks to look at. I'll go through those and then we'll do our typical closing routine here. Yeah, a typical portfolio, depending on, money's not as important as it used to be, but typically between 15 and 25 symbols is a really good portfolio to build. and that gives you enough rotation, diversity, all that kind of stuff. Okay, I've got some of these. I'll go back in the timeline and look. Yeah, so yeah, Tesla is running a little bit. Let's start there. Let me get to a daily. Yeah, we're seeing an interesting pattern. It's a daily Tesla setting up, and we're just trading into, we've actually exceeded the, no, I got the wrong one. Hang on. Try it again. Yeah, so Tesla is breaking out over and about to give a RTX sell signal, so it'll probably go flat for the next couple days, but we'll have an upward bias. We're looking at ppm1 at a 0.94 and all of that. Let me go back to our platform for a second. Yeah, I'm just looking to see what kind of position we have in Tesla. It's like it's long from about 625. Going back to TradeStation here, what we're looking at here is the, we really have to go to weekly. I talked about this a couple of weeks ago, is that this stock is going to stay around this 40-week moving average. That number is right now at 630. We're trading 656. We're going to be a bit above and below. This is what I call the demand line in this stock. And we're coming into a phase where we have substantial resistance on this stock at the 674 level. So we're coming up to the resistance right now. The ppm1 is down 1.19. I would expect to see, based on that RTXL signal, we'll get a reaction back in the next couple of days. But on a weekly basis, 674 is going to be about the top end of this market. Top end for this stock. So I brought up a company called TRCK Group. Not sure what they do. We did get this crazy spike a few weeks ago on this, and now what we're in is one of those bubble formations. The 10-pair moving average at 2.13. It's pretty cheap stock, but 2.13 is going to be major support here. But we're likely to just stay in the market grid probably on, this is a weekly chart, so we're looking at probably S2, R2 range, so that's 216 to 287 is going to be where this thing gets clocked at, and really pretty difficult to make any more kind of read on that. And bring up AMD weekly. We're right into actually a nice consolidation range here. This stock looks like to me we want it, it'll probably go higher. We're seeing the PPMs turn up, and we're going to try to get back above this 80, test this 89.20 level, maybe even first mark 85.77, get above there. We should see this thing start to turn up. PPMs are looking pretty good. PPM1 is in trend mode. So look for that support at 80.65, possibility 89. Maybe there's some more if we can get above that level that might start to develop an intermediate trend. So I'm going to stick with weekly charts on a lot of this stuff just to get through this stuff. Here's NEO. NEO's got one of these mixed pictures. PPM 2 is down, PPM 1 is up, so probably going major support on NEO 40, 41. As far as the upside goes, we go to the grid. 47.89 is going to be about the top end, at least on a weekly for this week. It does look like we're trying to set up a nice trend setting up. PPM 2 is starting to turn up, so this could start to move up and maybe do a retracement from these old highs. Maybe we can get into, maybe in the 51, 54 range on the upside, but the support will be at that 40.37. Yeah, it's funny, JJW. Yeah, Burry will scream for a couple years. Um, I guess to say Burry's right, to say Harry Dent will eventually be right as well. All right, move on. Got a couple I just randomly picked off the list. Here is Weststock WRK. Interesting, we have a weekly cycle coming in. So this week is probably going to be a cycle low. We hold this 5283 is going to be an important number, that 21 period moving average. We hold that, and we could start to see a retracement, maybe a resumption of the uptrend. But there's going to be probably 4 to 6 weeks of work in here, probably remaining below 56 handle. And if we get above that, then 60, 61 will be the top end of this one. Yeah, I know Burry was the original buyer, or one of them for sure. I guess Roaring Kitty was the big player that at least was visible, right? Yeah, if you weren't on for early in my broadcast, I went through quite a rant on the, we'll just call it the stupidity of predicting crashes. So, not that they don't happen, and I've been, yeah, watch the beginning of the video. That's the best way to get that. I did a good job of talking about it. Okay. Here is Disney. This week is also a cycle low on Disney. 40 period moving average 167.54 is big time number. Low 171 this week, 75 high. It's going to get above 183 to really start any real momentum here, but PPMs are set up really good. So this stock looks pretty good for at least a run back into the resistance zones, 175. Once we get over 178, then looking at maybe 188 plus. Could it make a new high? Absolutely. But this is definitely a low. The last time we had a cycle come in like this, you see in the middle of the screen, we had this cycle come in here on 121, and we had a nice run off of that. So this cycle event is big. this is one of the indicators, and I've got my guy working on this right now, but this will be a public indicator I'm going to put out on TradingView, and once it's completed, and this will just be an offering looking this cycle finder. There's a couple others I'm putting out. Hopefully they'll be done pretty soon. I see the S&P has turned south now. That's good. I like it. Yeah, NASDAQ has went south. Let's flash over to the markets here real quick. Yeah, nice sell-off into the close here. Yeah, I don't think... Yeah, we're coming into some big numbers in the morning. The GDP inflator, the claims, all that stuff. So I think those are going to be ugly numbers as well. Yeah, that's going to be pretty ugly. So we had a 30 low. I don't know if we can print a new low on the day or not, but that we'll see. We're pretty close. We're 3 handles off the lows of the session. About 10 minutes to go. Let's do another chart and we'll come back and focus on this thing coming into the close. What is this? I put in is this financial bull 3 times. Yeah, so we'll look at this index somebody put out there. I didn't know what it was, but let's go ahead and cover it. Yeah, we had some issues, Derek, with the indicators for TradeStation. That's a whole discussion there. Yeah, definitely getting some selling into the close. Okay, so FAS, this 3 times financial. This has got a demand line is at 99.20 or 99.90. We'll call it 100, trading 104, and PPMs are trying to turn up. So maybe this will play into my interest rate scenario. Time is it? Okay, we'll do one more stock and then we'll focus on the close. We look like we're still getting a bit of selling. Yeah, so this is Suncor Energy. You know, that's something we didn't cover. I didn't get to crude oil. I needed to go through crude oil, actually. I got here right on my notes to make sure I cover crude, and I went right by it when we were in the thrux of things. Yeah. All right. So we're looking at 10-pair moving average, 2334, ppm1, 1.65. So that's your major support. We hit it. This is weekly. We hit it last week. We hit it this week. We printed up to STX 2520, the high 2556. So we're definitely seeing this thing. We should see the market grid turn up, and it looks like everything's accelerating. So look for higher prices here. what time we got? 54. Do I have time? I do want to talk about crude oil, and I've been a number of weeks ago when we were down in the 60s, and let's say 4 weeks ago we were trading 66. I've been talking about a 75 number. We continue to move higher, and I believe we'll see something bigger than this number. Let me put on some Fibonacci projections here. So I've talked about these numbers a lot. The higher end numbers projecting to a $90 target range. You can see up at the right hand side on this chart, 90.89, 103. I think that's where we're going to be heading, but it becomes more obvious on the monthly. Really what we're heading toward is the 200-month moving average, and everything is expanding substantially. Crude oil will continue much higher. Not sure I need to say much more than that, but that is definitely what's going on. All right, let's watch the. We got about 5 minutes to go. The markets look like they're still under pressure a little bit. Yeah, we're getting pretty close to the bottom end of the trading range for the day. We'll see if we can make new lows as we come in. We're 31.75, 30.75 is the low. So we'll focus on this here just for a few minutes, and we'll see how this thing pans out. I think we probably saw the high end of this range, and we're going to come back into the range. Like I said earlier, there's some numbers around 42.17, 42.22. I'm going off memory right now. But if you rewatch the broadcast, I went through a lot of details here. And there's some pretty good support here. We are now, 75 cents off a new low for the session as we're seeing this thing set up. Yeah, I did go through our WRK. $32.25, $32.50, 4 minutes, 3.5 to go. So we'll see how this thing sets up as far as it goes. See who wants to square up positions. Now, I've talked to you folks a lot. What's going on right now is all the rebalancing ETFs. A lot of those guys come into play here in this last 5 minutes of trade is where they're going to square up a lot of positions. And it looks like there's more sells. They're getting some liquidations out there and a lot of this stuff. So we'll see if we can get like a hard surge with about to that final 2 minute mode, and then we'll hang around and watch a minute or so after the cash closes up and see how we trade here. So 175 printed. Okay. Yeah, so we're just kind of hovering here so far. Now we're into the final 2 minutes. So this is where a lot of action is going to take place, if there's going to be any. There's not a lot of, the last minute we should see volume on the bid ask really kick up. We're seeing some kick up now. We're 200 by 200 pretty much. Trade 31.50 briefly. See if we can get some. Be interesting if we can make new lows as we come into the close. just about into the final minute of trading, folks. Really want to thank everybody for coming on and hanging out today. I'm going to put up a screen in a minute. We still got about 400 people hanging around. So I'm going to put up a screen, special offering that we're doing, and you really should consider coming on board with us, because there's going to be a lot of need for a structured process. Somebody said they got out early, probably didn't need to do it. Here we go. We are looking at almost a new low here, 31.25 printed, maybe 31 even. Let's see what that low was. 31 evens. Evens did trade back to 32.50. This is the final minute. We're seeing we went from, now we have 700, 800 on the offer. They're hammering the bid a little bit here. 31's almost at the lows. See if they can, there we go. New lows on the session. We're definitely seeing a lot of selling here. That was the close, so we'll watch another minute of this thing. So we printed into 30.50, back to 33, so a little short covering. So what happens here is that these guys get the reports back. They see how many stock they were able to go. Thanks, Super Donkey. I appreciate it, man. I really do. So what we're seeing here is scoring up of books. We're trading back at 350. So we did manage to print a slightly new low, and then there's some short covering. They're buying back some of these contracts that they were selling coming into the close. They're getting reports back from what they got done on the close from their individual stocks. So that definitely looks like that was it. Little short covering, nothing, no real big deal. Be interesting to see how this thing comes in the morning. I think there's going to be some protection taken. We've got GDP third revision coming out. We've got the claims numbers coming out, and that's pretty much all the market has this week. You know, Powell was able to do, you know, maybe hype the market enough to get it up a half a point yesterday, but no follow through today. What I want to look at here, this is important here. SPX actually closed lower, and I told you this was going to be important for this cycle. So if you didn't want to see the beginning of this stream, go back and watch the replay when we get done, and that'll give you a lot of insight on what I'm thinking about here. But this is a negative close after a cycle. I'm getting the badges from Market Watch saying NASDAQ hangs on to gains, S&P closes lower, you know, the typical clickbait that comes out at the close and all of that. So like I said, I think this is reasonably negative. Futures bounced back a little bit, but not, you know, nothing material here. So I suspect we'll trade down into 29 handle, 28 handle overnight at least on the futures as we go through there. Yeah, so anyway, I'm going to put up, I'm going to put this screen up for a minute, folks, and I'll continue to talk to you. But this is the way to get to our entire suite of products, and normally it is $8.95 for a quarter. It's 30% off. It is actually $5.91 on the special offer. If you're not currently a subscriber, then you can get there and check it out. There is no trial, but one of the things that I'm telling everybody, I'm going to be doing some personal one-on-one, not one-on-one, but in a Zoom meeting, we'll be doing a lot of training just for the platform. So make sure you check this out. I want to thank everybody for coming today. I really appreciate it. I would definitely, you can go to this link that's up here, and that'll get you there, and you can see what goes on. Um, yeah, I'm just looking at some of your comments you guys are going. No, what I was saying about the S&P is that it would trade. It's at right now. S&P's 42.33 will trade down to 42.29.28, not 29.29 handles down. Just so you know, make sure that you're clear. And thanks everybody for watching. I really appreciate it. You know, I would say that the institutional money used to be something to pay attention to. They're still the big player, but the retail revolution is real and happening. And that's going to be interesting as far as coming back to as the markets go forward, I think. Yeah, thanks everyone for coming and participating. Really. Yeah, make sure you subscribe, hit that. We're right at 30,000 folks. So I think we're under 500 new subscribers to get to 30,000. So make sure you hit the like button so YouTube knows that we're good people, and hit that subscribe button. It doesn't hurt at all. Yeah, the retail market probably, retail money probably does make the markets more volatile, but I do believe this is the beginning of the wave, not the end of it. I think more and more people are going to get into play. Fractional shares are a big element. No transaction costs are a big element. So a lot of folks get to play and be involved. Yeah, M1 did get discontinued along with M2. Yeah, so yeah, it's not about being optimistic. I think it's about the probabilities that exist. And when they change, you'll see me flip on a dime. Yeah, probably MMT to the moon. Yeah, absolutely. All right, guys, I'm going to take off. Thanks for coming today. I really appreciate it. And we will be back tonight on my usual video, and then next week, same time, same station.